certainly U.S.-China tensions are going to escalate going forward. Now, the purchase targets for the first phase one trade deal was a stretch in any case, and with the unexpected impact of the COVID-19 crisis, by our estimates, it is now almost impossible that the Chinese will hit these targets. So it wouldn't be surprising that the Chinese are withdrawing purchases, likely to get as much leverage as they can before a renegotiation going forward. And I think that it might be reasonable for the US to be willing to renegotiate given that the pandemic was unexpected. But it is worrying that the message from the White House recently is that they will expect the Chinese to stick to their commitments. And even more worrying is that they are sending out messages that perhaps China should be penalized for starting the pandemic. And this points to more tension going forward, and it will lead to more volatility in markets, in our view.
Where does that leave you then in terms of your outlook and strategy there? How are you feeling about Asian equities?
We think Asian equities has likely been, the rally since its bottom from late March has likely been a little bit too much too fast. And there could be a near-term consolidation going forward before making more gains as we emerge from the pandemic. Now, the market has been very focused on the fact that we are past the worst in terms of infection and the worst of the economic impact. And the market has also been buoyed by the fact that stimulus is working. But where prices are right now for global equities, particularly Asian equities, I'm not sure that the risk of the U.S.-Chinese conflict and the fact that there could be second wave of infection and the fact that the path towards normal, going back to 2019 levels of GDP, could be a long and tenuous one.
Hi, Eli. It's Dan here in Perth. How would you characterize the unrest that we're seeing across the United States right now, and how consequential is it for the US dollar and the outlook for US equities?
I think this is one more straw on the camel's back. The US equity rally has been extremely strong, and most of this has been driven by the rally in the tech sector. And for this to continue, we will need to see the rotation towards cyclical sectors and also other sectors that haven't rallied as much. But given that the recovery should be uncertain, it is hard to see this panning out. And I do think that there should be some consolidation in the US equity markets going forward as well.
Okay, so neutral Asia and expecting consolidation in the United States. Where is the opportunity today then? When you look at these rising trade tensions, you look at the unrest in the United States, clearly a lot of concerns about the macro outlook as well. Where can you put your money and expect a decent return?
Now, we do expect interest rates to stay near ultra-low levels. And in fact, the futures markets is pricing in some likelihood of negative rates even in the US at this point in time. And inflation will creep up, but likely not be a big problem over the next 1 or 2 years in our view. And this backdrop will be extremely attractive for investors looking for yield. And we think there's still a good opportunity in emerging market high yield, particularly in Asian high yield, where I think micro fundamentals are still quite sound. There could be scope for some near-term volatility. Default rates are likely to increase from what is now a very low base. But over the longer term, we think that the carry in this asset class is attractive, and it should be a very important component of investors who are seeking attractive risk reward over the next 2 to 5 years.